Your credit score isn't a scorecard for smart money. It's a ranking lenders built for lenders to decide how profitable you are to loan to. Chase it, and you can burn a decade improving a number that drains your wealth while telling you you're winning. A national consumer survey run for FICO by Harris Poll in 2025 reported that 71% of American adults now check their credit scores multiple times per year. Here's the strange part. The highest scorers aren't always the richest people. They're often the most profitable customers lenders have ever had. And that rewrites everything. You open your banking app, and your score sits right at the top with a little green arrow. That arrow feels like yours, a personal trophy. It's not yours. It never was. The company behind that number, Fair Isaac, was founded in 1956 by two guys named Bill Fair and Earl Isaac. The general FICO score lenders use today didn't launch until 1989. From day one, the product was the same. They weren't trying to help you budget. They were selling a tool to banks. The pitch was simple. Hand over a borrower's file, and we'll tell you how likely they are to pay back and how profitable they are to hold. That was the pitch. That is still the pitch. The word that stops people is profitable. This model was never just about default risk. It was about which customers make a lender the most money while still paying on time. The industry even has names for the two types. Transactors pay their balance in full every month. Revolvers carry a balance and pay interest. The Federal Consumer Bureau's 2023 Credit Card Market Report confirms what the industry already knows. Revolvers drive the bulk of card issuer profits. If this were bad for me, they wouldn't give it to me for free. Sounds like common sense. Now think about who else gives you things for free. The casino gives you drinks. Free usually means you're the product being measured, tuned to keep you engaged with someone else's goal. According to Fair Isaac's own 2025 corporate statement, the FICO score is used by 90% of top US lenders. That's the real audience. A room of risk officers and underwriting algorithms, not you. But there's a catch. This score was designed inside lender offices, for lender dashboards, to serve lender decisions. Your access to it came decades later, almost as a marketing afterthought. For roughly the first 25 years, you couldn't see your own number without paying for it. Then, in November 2013, Discover became the first major card issuer to print your FICO score on your statement for free. Log in, see the number, feel the hit, come back tomorrow. The app was never your grade, it was your leash. The paying customer of this product is the lender. You're the inventory on their shelf. Then why does the app slap it on your home screen and treat it like a badge? You Google, "What moves my credit score?" and half the internet tells you something different. Every article shows the same 5 factors: payment history, amounts owed, length of credit history, credit mix, new credit. 4 of those 5 reward one thing: staying a borrower for a long time across many types of loans while the company watches. A great score is literal proof I'm responsible. It's proof of something, just not what you think. It's proof you're a long-term user of credit products who pays on schedule, across a variety of account types. Useful information. To a lender. Here's the part nobody tells you. 2 of those 5 factors do almost all the real work on your number. Payment history is 35% of the score, the biggest slice. Amounts owed, which really means utilization, is 30%. Length, mix, and new credit split the remaining 35%. But there's a catch. 2 of those 5 factors barely move your number, and the industry would rather you keep obsessing over them than figure out which 2 actually do. Why would anyone want you obsessing over the weak 3? Credit mix means opening more types of loans. Length means keeping old accounts open forever, which keeps you tied to an issuer. New credit means hesitating before you apply somewhere else, which dampens your ability to shop around. All 3 nudge you toward being a longer, deeper, more varied user of borrowed money. Listen to the advice next time someone coaches you on credit. Open a second card for mix. Keep that dusty card alive just in case. Don't rate shop too aggressively before a mortgage. Each one is technically true to the model. Each one also happens to benefit the company giving the advice. Rule of thumb: if a tip on improving your score requires you to open a new product, carry a balance, or leave a card open you don't use, it's not helping you, it's farming you. The real moves are boring. Pay on time. Keep reported utilization low. That's most of the game. What happens when you do the most responsible thing imaginable, and the score punishes you anyway? You make the final payment on your car loan and wait for the score to jump. It doesn't jump. It drops. Sometimes by a lot. You paid in full. You paid off a debt. Every teacher, parent, and finance book told you this is the goal, and the scoreboard just docked you points for it. I paid off the loan, the score should go up. Welcome to the payoff paradox. When you close an installment loan, two things happen inside the model. You remove an active trade line, so your file has fewer ongoing relationships in it. Depending on what else you carry, you can thin out your credit mix at the same time. Both read as less activity for the model to score. FICO's own education site confirms this mechanic in plain language. Quote, paying off your only active installment loan can result in a score drop. The company that built the model put it in writing. Being debt-free isn't neutral to this system. It's a negative data point. But there's a catch. Paying off the loan the responsible way can shave points off the very number the system told you that loan was supposed to prove. The score doesn't reward you for escaping debt. It rewards you for staying in a healthy, ongoing borrowing relationship. The finish line you thought you were crossing was actually the exit door of the loyalty program, and the door clipped your ranking on the way out. None of this means you should keep debt to pad a score. It means the score is telling you what it actually measures. Engagement, not freedom. If you get docked for closing a loan, what exactly is the number measuring? You pay your credit card in full every single month, on time, and your score still reads like you're swimming in debt. This part breaks people. The ratio that drives a huge chunk of your score is called utilization. Reported balance divided by credit limit. Sounds simple. Now look at the timing. Utilization isn't captured on your due date. It's captured on your statement closing date. Those are two different days, and that gap is where the trap lives. I pay in full every month, so none of this applies to me. Here's why it applies. Your statement closes, the bureau snapshots your balance, and 2 weeks later, you pay in full. Perfect behavior. On paper, the bureau already wrote down a utilization that looked high because the snapshot happened before the payment. Let's see. 2 cards. Card 1, limit 3,000. Statement close balance 2,700. Card 2, limit 5,000. Statement close balance 500. Add the balances. Add the limits. Divide. That's 3,200 owed on 8,000 of credit. 40% reported overall utilization for the month. Now look at card 1 on its own, because the model reads individual card concentration too. Card 1 is at 90% utilization at the snapshot, and the model flags that single card spike on top of the overall total. Your score reacts to both reads. Your payment habits were clean. The snapshot read you as near max. But there's a catch. The ratio that sets your utilization is captured on a reporting day that is not your due date. So paying on time and reading as maxed out can happen in the very same month. Rule: find your statement closing date in the card app. Pay the card down to a small balance a few days before that date. Then let the snapshot happen on a clean number. Your due date payment still goes in as normal afterward. You're not paying extra. You're paying earlier on purpose, so the file records the version of you that actually behaves responsibly. Most people never hear this once in their adult lives, and it costs them real rate tier points for no reason. You kept everything in cash your whole adult life, proud that you never owed anybody a dime. You go to rent an apartment or lease a car, or open a phone plan, and the computer blinks. Then it asks for a deposit, or a cosigner, or it says no. I don't borrow. That should be a badge of honor, not a problem. A Federal Consumer Bureau update released in June 2025 estimated that 2.7% of U.S. adults were credit invisible and another 9.8% held an unscored file. Together, 12.5% of adults. An earlier federal report from 2015 put the combined figure closer to 19%. The exact numbers move over the years, but the shape of the problem doesn't. To the model, you're not a responsible non-borrower, you're a stranger. The model can't price strangers, so it defaults to the worst possible assumption about you. But there's a catch. A clean record of never owing anybody $1 reads to this system as a stranger with no story. And strangers get the worst products, or no product at all. When the model can't read you, lenders do one of two things. They reject you outright, or they funnel you into their starter products. Secured cards with a deposit. Higher deposits on utilities. Dealer financing with a cosigner at a worse rate than the tier you would have otherwise earned. You thought you opted out. The system routed you into its entry level instead. Rule: if you never plan to carry debt, keep one card open, run a tiny recurring charge on it like a streaming subscription, pay it in full every month, and let it sit. That's the minimum viable credit history. You stay visible without feeding the scoreboard. Doing nothing hurts you. Doing everything hurts you. So, what game is actually being played here? You sit in the finance office of a car dealership, and the salesperson says your rate is based on your credit tier. Listen to that word. Tier. Not grade, not score. Tier. Airlines have tiers. Silver, gold, platinum. Every tier pays a different price for the exact same seat on the exact same day. This isn't a scorecard, it's status pricing. Experian State of the Automotive Finance Market reported that in Q4 2025, super prime borrowers got new car loans at 4.66%, and deep subprime borrowers got them at 16.01%. That's an 11.35 percentage point gap. Same car, same loan amount, same month, 11.35 points apart, just because of which tier you landed in. 1 point under the tier line. What's 1 point? Here's what 1 point is. The tier lines are drawn by lenders, not by you. They shift quietly between years and even between lenders on the same day. If you sit one single point below a cutoff, you don't get the next tier's rate. You get everything the tier you fell into charges for the entire life of the loan. Here's quick math. Borrowed amount $40,000 over 72 months. Move the rate from 6% to 7%, a single point. Your payment goes from $663 a month to $682, only 19 more a month. Over 6 years, that 1 point you shrugged off quietly bought the lender an extra $1,369 of your money. On a 30-year mortgage for $400,000, that same 1 point between 6.5% and 7.5% costs you roughly $96,700 over the life of the loan. But there's a catch. Sitting one single point under a tier line can cost you more over the life of a loan than most people save in a full year of budgeting. The score is a loyalty tier. The point of the game isn't to be the platinum customer. The point is to land just above the cutoff for the rate you actually need. Anything beyond that line is free labor for the lender, paid in the effort you put into chasing a number that was never going to change your life. That's already strange enough. Now watch what happens when this tier system leaks into decisions the score was never supposed to touch. You get an auto insurance renewal quote, and it's higher than your neighbor's, even though your driving record is cleaner. You check the fine print. Somewhere in there, next to the stuff about accident history, is a line about a credit-based insurance score. According to the National Association of Insurance Commissioners, roughly 7 U.S. states prohibit or significantly restrict the use of credit-based insurance scoring in auto or home policies. The usual list is California, Hawaii, Maryland, Massachusetts, Michigan, Oregon, and Utah. In most other states, the tool designed to predict loan repayment is quietly setting the price of your car insurance, often your homeowner's insurance, sometimes your utility deposit. In certain states and industries, your employment screening. This is just another banks are evil rant. It isn't. This is a data leak. A tool was built to answer one question: whether you'll pay back a loan. That tool is now answering questions it was never designed for. Insurance risk isn't loan repayment risk. FICO itself publishes this. The consumer FICO score predicts delinquency. The insurance score predicts claim losses. Different goals. Same raw credit file. Files are cheap. Training new models is expensive, so the industry reused what it already had, slapped a different label on the output, and sold it as a credit-based insurance score. Same source material, new product, new price tag for you. 2 drivers, same clean record, same car, same zip code, different credit tiers, different quotes on the exact same policy. That isn't risk math. That's a pricing strategy dressed as one. No hidden twist in this segment. Just notice how far this ranking has traveled from the room it was born in. It started as a lender tool. Now it touches your insurance bill, your deposits, and in some states, your shot at a job. Rule: know where the score is allowed to follow you and where it isn't, because that differs state by state. When a provider quotes you a price, ask one blunt question: are you using my credit file to set this price? If yes, ask what they'd quote without it, or shop to a carrier that doesn't pull it. You'll find the difference fast. And yet, even after all of that, there's still something the score doesn't actually decide. You walk into a mortgage pre-approval with a high score, feeling locked in. The loan officer smiles, nods at the number, then asks for your last 2 years of tax returns, your bank statements, and a breakdown of your monthly debts. This is the second file. the one nobody coached you to care about. A 2025 review of 2024 federal mortgage reporting data found that 34% of denied mortgage applications were turned down primarily for debt-to-income reasons. Credit history came in second, around 25%. The top reason mortgages get denied in this country isn't the score, it's debt-to-income. The thing almost nobody is coaching you on, while everyone is coaching you on the score. I need the highest possible score to buy a house on good terms. A high score gets you past the door. The real terms happen in the second file: your income stability, your debt-to-income ratio, your cash reserves, your assets. Underwriters aren't reading your trophy. They're reading whether you can actually service the payment under stress. Add up all your required monthly debt payments, card minimums, car loans, student loans, the new mortgage payment with taxes and insurance baked in. Divide that total by your gross monthly income. That percentage is your DTI. Fannie Mae's selling guide caps conventional loans around 45% to 50%, depending on the underwriting path. Two applicants with the exact same score, one with a DTI of 33% and one with a DTI of 46%, walk out with very different answers. But there's a catch. The score gets you through the door, but the real price on the other side is set by a second file you were never told to look at. Checklist before you apply for anything real. 1. Know your DTI to the decimal point before the lender tells you theirs. 2. Build cash reserves, because underwriters count months of reserves as a direct offset to risk. 3. Stabilize income for a clean 2 years before the application, because job jumps without a documented pattern scare underwriters more than an average score. 4. Treat the score as a door key, not the whole building, and stop trading real financial moves for score optimization moves. If the door key isn't the point, what exactly is the point? You spend another Sunday afternoon clicking through 3 different score apps on your phone. You watch the needle twitch, up 1 point, down 3. You refresh. Checking my score hurts it, so I can't experiment. Half true, and the half that's false costs you nothing to correct. Hard inquiries from an actual loan application can ding your score by fewer than 5 points and stay on your file for 2 years. Soft inquiries, the kind the free apps and your own check through your card issuer count as, don't touch it at all. The monitoring isn't the problem, the obsession is. There's a minimum viable credit profile. Past that line, more effort buys almost nothing measurable in dollar terms. Before that line, small, boring moves buy a lot. Most people spend years grinding on the wrong side of that line, polishing a trophy that stopped paying interest savings 100 points ago. Checklist that actually saves money. 1. Pay every bill on time, every time, because late payments are the single biggest permanent stain on a file. 2. Keep statement close utilization below the number the model wants, using the timing trick from earlier in this video. 3. Keep 1 or 2 old cards open with small recurring charges, because length of relationship is cheap to maintain and expensive to rebuild. 4. Don't open new credit in the 6 months before a major loan, because every hard inquiry in that window reads as desperation to an underwriter. 5. Stop chasing the last 20 points. Those 20 points almost never change your rate tier, and the effort would be better spent on the DTI side of the ledger. Everything else is score worship. Score worship is the game the industry wants you to play, because it keeps you engaged, opening products, calling customer service, extending the file. It doesn't buy you freedom. It buys the lender a longer, richer relationship with a predictable borrower. You'll see that number again tomorrow morning, right at the top of the app. Only this time, look at it for what it mechanically is. A loyalty program score. The reward is being allowed to borrow more money at better terms, as long as you stay a predictable borrower. That's the whole product. That's the whole trick. Silver, gold, platinum, and a rate card that changes depending on which badge you wear. Actually, wealthy people don't chase this number. They use it when they need it, and they ignore it the rest of the time. They pull the card when it saves them money on a real transaction, then put it back in the drawer and get on with actually building assets. One portable question finishes this whole thing off, and it works on every financial product you'll ever see. Who benefits if I optimize for this metric? If the honest answer is a counterparty, not you. The metric is theirs, not yours. Use it when you need it. Don't build your life around it. The credit score was never your scoreboard. It's the lender's scoreboard. And you've been cheering in their stadium, in their jersey, while they ran up the score on you. Use the number. Don't worship it. Next time an app congratulates you on that green arrow, smile, close the app, and ask what the real file says about your money. That's the number that actually builds your life.